Are you looking for a side hustle or to create a little extra income on the side? Well, learning about stock options and then using them is a great way to do just that. If you're already investing in stocks, there's really no reason why you shouldn't be using them to add some extra income onto what you're already doing. In this video, we cover puts and calls 101. It's basically a very simple explanation of what they are and how they work. Plus, I'm going to show you some real examples. By the end of the video, you should have a solid understanding of what to do with options. Fair warning, it does take a little bit of effort to wrap your head around the concept in the beginning. However, it is worth it, and you can generate a nice side income once you understand them while trading just a few minutes a week.
Hey guys, Darren here. Thanks for joining. We talk about action steps you can take today to increase profits and reduce risk in your options trading portfolio. Please check out and download the free options workshop in the link below.
It talks about the two main reasons why options can be less risky and more profitable than just buying stocks alone. It also details how to profit in both directions and pick your win percentage, which you can't do just buying stocks. Please hit the like and subscribe button below. I appreciate it, and it helps to get the video out to more people. Disclaimer, I am not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. Alright, to make it simple, let's compare options to something that you already know, buying and selling stocks. Here's a price chart of Apple. It's currently trading at 150. You think it's going to go up, so you buy it at 150. Then it goes up to 190. So you sell it at 190 and keep the $40 profit. Let's say you're wrong and Apple instead drops to 100. Then your loss would be your purchase price of $150 minus the current $100 price, so it would be $50. You can see that your profit and loss is linked dollar for dollar with the stock price. If Apple goes up $50, you make $50, and if Apple goes down $50, you lose $50. So that's how options work when you buy a stock. Now let's take a look at how it works when you buy an option. When you buy a stock option, you are buying the right to transact on a stock at a specific price before some predetermined expiration date. So what if instead of buying Apple stock for $150, you bought the option to buy Apple stock at $150? So it's kind of the same thing, but slightly different. Now this type of option where you buy the right to a stock is called a call option. So let's say this call option costs you $10 and gives you the right to buy Apple for $150 at any time prior to the expiration date. Isn't this the same as actually buying the stock for $150? So let's say Apple goes to $190. As the call option buyer, that's great news because this gives you the right to buy the stock at $150, which is also known as the strike price. So you exercise your right to buy Apple at $150 and then turn right around and sell it for the current price of $190. Again, you make $40 just as if you own the stock at $150. However, keep in mind that you paid $10 for the option, so your profit is actually $30 since you need to take into account the $10 option cost. However, you only paid or put up $10 to do this. So think about it. You put up $10 and made $30. That's a 300% return on your money. So that's how it works if Apple goes up. But how about if Apple goes down? Let's say Apple went down to 100. Well, that's not great news for you. You paid $10 to buy the stock at 150. But who wants to buy something at 150 if it's only worth 100? That would be a loss, right? So instead of exercising the option, it just becomes worthless. So in other words, it's a $10 loss for you from the amount that you paid for the option. However, here is the interesting thing. What if you bought the stock outright at $150 and it went down to $100? You would have lost $50, right? Well, having bought the call option, you only lost $10, so you reduce your risk. Even if Apple or the company you are trading went bankrupt and went down to zero, you would only lose $10. So let's take a look at a graph of buying stock versus a graph of buying a call option. As you can see, the graph of buying stock outright is 1-to-1 a straight line. As the stock price moves up, you make dollar for dollar with that stock price, and the same if it moves down. And the graph of buying the call option is more like a hockey stick since the downside is limited or capped off at the price that you paid for the option. But you still have the same upside benefit. This is the key difference between trading stocks and options. However, it's not always just good times. There's always a trade-off. Because options are not free and there is an expiration date, this means that you have to be right on the direction and you also have to be right quickly within a certain period of time. This is more difficult than it may seem. Most people that buy options pay a lot of money for options that end up expiring worthless. Buying options overall long-term is a losing strategy. Statistically, it's much better to sell options versus buying them, especially if your goal is to create consistent cash flow. So now let's really break down in detail how a call option works with a real example on the Tastyworks trade platform. I'll put a link down below. It's the best option trading platform. Here's a call option in Apple. The strike price is $150. The expiration date is March 17th, 23 days from now. The cost to buy this option is $395. Yes, they're a little bit more costly than the $10 in reality. One option contract equals 100 shares of stock. So it's the $3.95 times 100 shares, or $395. Now, when this trade is placed, there needs to be a buyer and a seller on the other end of it. So let's say Jim is buying this option and Sally is selling it. So Sally agrees to sell it for $395 and Jim is willing to buy it for that price. Once the trade is placed, Jim has the option or the right to buy or exercise the stock at $150 anytime before the March 17th expiration date in 23 days. The stock is currently trading at $148.48. Now let's see what happens to both Sally and Jim when the stock moves up. If the stock price moves up to $170, then that's good for Jim since he bought the call option. Now Jim has the right to exercise the option and sell the underlying stock since he bought the option and owns it. At the same time, Sally sold the option, so she has the obligation to buy the underlying stock should Jim choose to exercise. In this case, if Jim exercises, then he will buy the stock at $150 and sell at $170 for a $20 profit. This is really $2,000 since one contract is equal to 100 shares of stock. However, Jim paid $395 for the option or right to buy Apple at $150. So his profit is $2,000 minus the $395 or $1,605. On another note, since the underlying stock price moved up past the call strike, it is said to be in the money. Now, Sally lost on this deal because the stock price rose and broke through the $150 strike price. Sally loses $2,000 on the move. However, she collected $395 up front, so she really lost $1,605. As you can see, one side won and one side lost. And Jim paid the $395 in premium for the right or the option to buy the underlying. In turn, Sally collected the $395 in premium since she took on the obligation to sell the underlying stock at $150 strike price. Let's now take a look at what happens when the stock price moves down below the strike price. Let's say the stock price drops to 100. So Jim, who is the call buyer, has the right to buy the underlying at 150. However, would he really want to buy it at 150 when the stock is actually priced at $100 currently? Of course not. So this option he would just leave alone and let it expire worthless. The option is also known as being out of the money. Jim is out the $395 that he bought the option for up front. Now Sally collected $395 when she sold the option. Since the stock price moved down and it's worthless, she doesn't need to be concerned with Jim exercising it since he would lose money if he did. So the option just expires worthless and Sally keeps her $395 that she collected in premium when she placed the trade. So when a stock price ends up out of the money or below the strike price, it's good for the call seller and bad for the call buyer. Buying a call is a bullish trade, meaning that it benefits when the underlying stock price moves up. Selling a call is a bearish trade that benefits when the stock price moves down. Give this video a thumbs up if this makes sense. Like I said, it takes a little time and thought to wrap your head around when first learning, but it starts to make sense pretty quickly and especially after you've done a couple of trades. Also, if you like having something in your hands to study, download the free option strategies trading guide. I'll put a link down below. It breaks down the different option strategies and is something that you can keep by your side when learning options and starting to trade. Okay, now let's talk about put options. A put option gives the buyer of the option the right to sell the underlying stock at the strike price on or before the expiration date. Here's an example of buying a 145 put option in Apple. Let's say that Jim again is the option buyer and Sally is the option seller. The cost to buy the 145 put is $295. So Jim pays Sally $295 for the right to sell the underlying stock at 145 anytime prior to the expiration date of March 17th. If he does exercise that right to sell, then Sally is obligated to buy that underlying stock from him at the 145 strike price. For this obligation, she collects $295 in option premium that Jim paid for the option. As you can see from the profit zone shown in green, Jim will benefit and make more money when the stock price moves further down. His max profit would be capped if the stock went to zero. On the other hand, let's take a look at what Sally sees when she sells a 145 put option in Apple. As long as the stock price of Apple stays above the 145 strike price, she keeps the $295 that Jim pays her in option premium when she sells the option. Sally's max profit is capped at $295 premium collected up front when the trade is placed. Buying a put option is a bearish trade, meaning it benefits from the market going down, whereas selling a put is the opposite. It's a bullish trade and it benefits from the stock price moving up. This was a lot, but trading options really boils down to this. There are only two types of options, calls and puts, and there are only two things that you can do with those options. You can buy them or sell them. If you buy an option, rather a call or a put, you pay a premium and you are buying a right. If you buy a call, you are buying the right to buy a stock underlying. If you buy a put, you are buying the right to sell it. If you sell an option, you collect a premium or credit. The option seller always has the obligation to take the other side of the trade. The seller is selling the obligation. Now that you understand calls and puts, the real question is, what do you do with them? How do you trade them? We will cover that in upcoming videos. You will see that it's much easier to make consistent monthly income by selling options rather than buying them.
All right, guys, I put a link down below for the free options workshop. Be sure and grab that. Also, let me know what you thought of this trade and what you're trading in your options trading account. Thanks for watching and see you in the next one.